Investors in the market have historically held mixed feelings towards small-cap stocks. On one hand, these belong to up-and-coming firms that are yet to establish themselves in their respective markets, and are extremely volatile in their price movements. On the flip side of this, these stocks hold a staggering growth potential that cannot practically be achieved by holding stocks of companies with large market capitalizations. Based on the present inflationary conditions of the market and especially in the tumultuous third quarter, small-cap stocks have performed impressively on a relative basis. Analysts explain that this stellar performance comes due to both their high growth potential, which investors desperately seek in these bearish conditions, as well as their incredibly cheap valuations. This situation has led to a bullish rush for this category of stocks. Asset managers in the market have been quick to identify this opportunity, which explains a newfound preference for small-cap stocks amongst institutional investors. In this video, we shed light on some of the most promising small-cap names in the market. Market participants too could see their portfolios climb high with these stocks, even in the wake of a potential recession. The first stock on our list is Ranger Oil Corporation, a small oil and gas company that trades with the ticker ROCC. This Texas-based oil explorer, developer, and producer has a market capitalization of $1.4 billion, as well as reserves of approximately 241 million oil barrels, as of the 31st of December 2021. The company has been gradually upping its stakes on the Eagle Ford Group zone by small yet strategic acquisitions, which is enhancing this small player's positioning in the oil market dominated by giants. This approach has been proving highly advantageous to the company, considering that it has seen its annual revenue jump up from $259 million to $550 million, from 2020 to 2021. The Ranger Oil Management, which strongly argues that the company is undervalued, has set its 2022 guidance for annual revenue at over $1 billion. This incredible performance had also been translated on the company's bottom line front, where in its most recent quarter it reeled in an EPS of $5.60. This was highly above analyst consensus, which estimated an EPS of $2.65. The company managed to enhance its quarterly earnings by a staggering 1,600%. Based on these trends, Ranger Oil Corporation is highly likely to progress beyond the small-cap category, and therefore presents a prime growth opportunity for investors to consider. The second stock on our list is that of Target Hospitality, the hospitality services company which trades by TH. The company offers a range of services, including security, housekeeping, food catering, amongst a wide range of others. Since the relaxation of COVID-19 restrictions, the business has been booming for TH, and its performance improves tremendously. The company is well positioned for tremendous growth, as is reflected in its price change over the last year. In just 12 months, TH has climbed from over $3 to almost $13, translating to a price appreciation of nearly 300%. In its most recent release, TH saw its quarterly revenue jump up from $75 million to $110 million on a year-on-year basis. During this same period, the company turned around its net loss of $912,000 to a profit of an impressive $23 million. This was in large part due to favorable conditions in the hospitality industry, which caused bed utilization to further improve from 72% to 78%. The nature of Target Hospitality is such that it remains relatively immune to the wider macroeconomic complications arising due to Russia's invasion of Ukraine. Its services see no disruption in the wake of the wider global supply chain breakdown, which is why it has been booming amid such severe global headwinds. Although inflation could slow down the company's growth, it is well suited to further take off and expand its operations. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Number 3 on our list is InvenTrust Properties Corp, the multi-tenant retail REIT which focuses on grocery-oriented neighborhood centers, and which trades by the ticker IVT. IVT holds an extremely attractive valuation, considering its price fall of over 25% in just the last 6 months. At a cheap price, investors have within their reach a set of high-quality assets and a premium balance sheet that is positioned to enjoy a steady flow of business, even in the toughest of economic climates. With its 62 shopping centers, IVT offers exposure to the brick-and-mortar dimension of retail, which remains extremely reliable to count on. Given InvenTrust's prime Sunbelt positioning with some of the top-grade tenants, the company has been seeing tremendous improvements in its space rent and occupancy. In its most recent quarter alone, IVT signed up to 144 leases, which further strengthens its position. Investors in IVT can enjoy a dividend yield of up to 3.7%, which is impressive amid a recessionary climate. What is most impressive, however, is the dividend growth rate of the company, which stands at over 41%, reflecting that the management is keen at returning the rapidly growing business value to shareholders. IVT offers stable income, at a highly attractive valuation, despite its market capitalization of only $1.5 billion. For the fourth stock on our list, we take a look into the fashion industry, and shine a light on Oxford Industries Incorporated, the Atlanta-based apparel company which trades by OXM. The company holds some of the top clothing brands of the fashion industry, which include Tommy Bahama, Duckhead, Southern Tide, and a wide range of others. The most recent brand acquisition took place last month, when Oxford Industries acquired Johnny Was for a total of $270 million. OXM is also highly attractive from a value standpoint, considering its epic business and financial performance, as well as the fact that the stock is trading 12% lower than it did at the start of the year. Between the period of 2020 and 2021, OXM saw its annual revenue rise from $748 million to $1.1 billion, given the improving business environment. In its most recent quarterly release, the company saw top and bottom line growth of 11% and 15% respectively, on a year-on-year basis. For an attractively valued company such as OXM, where every metric points to impressive performance and growth potential, the stock is considered a must-buy. With its market cap of merely $1.4 billion, Oxford Industries holds a tremendous long-term growth runway that is worth exposing one's capital to. The final stock on our list is the Dallas-based single-tenant REIT, NETSTREIT Corporation, which is also referred to as NTST. NETSTREIT's growth can be visualized by taking a look at its average acquisition activity per quarter, which has been rising steadily over the years, and expanding its portfolio. The management of the company is clearly focusing on a steady growth business strategy, which exposes its shareholders to a steadily rising growth runway. At present, the company holds over 380 properties, spaced across 42 states and 24 different industries. This degree of diversification, combined with steady growth, makes NTST an extremely safe play, despite having an enormous growth runway. Another reason which makes NETSTREIT one of the best small-cap REIT names out there, is that it is focused on some of the highest-grade retail tenants, which include Walmart, Best Buy, CVS, Walgreens, and a wide range of others. In the services sector, NTST has leased out its properties to KFC, Taco Bell, 7-Eleven, as well as Chick-fil-A. The nature of such a robust balance sheet makes the stock a highly defensive one, as well as rock solid in its safety profile. The company also has largely diversified the e-commerce risk which most REITs are exposed to, which further adds to its attractiveness. Given all these core plus points, NTST saw top-line year-on-year growth of over 65% in its quarterly revenue, as per its most recent release. The stock is a highly compelling one for investors, that has its strengths far outweigh its risks, and is therefore a screaming buy. That's all from us in this video. We hope the insight we aimed to deliver has proven valuable to you, and would allow you to ensure your portfolio is well exposed to the dynamic growth opportunity present in the wider opportunity of small cap stocks. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.